Hello, and welcome to Chapter 8 of Fundamentals of Financial Accounting. Before I continue, I'd like to remind you to download the blank Word file from SFU Canvas and follow along with the paper in front of you. Internal control, the organizational plan company used to protect their assets and records. The four main objectives that internal control aim to achieve. So internal controls are designed to protect the company from external harm, and this is what's implied by this umbrella here. There are four major objectives underneath the umbrella: operational efficiency, preventing or detecting error and fraud, safeguarding assets, and accurate, reliable information. Let's talk about all of these things here. Operational efficiency refers to optimizing the use of resources while adhering to internal and external policies. And these policies can be operational or they can be reporting. So the idea here is if you have a solid plan in place, be it for a manufacturing or a service providing firm, you tend to have better performance, better use of your assets because people have clear guidelines about what they should be doing. Point two, preventing and detecting error and fraud. This helps prevent waste of company resources due to theft or error. So by having a sound policy and following it, you're continually checking to ensure that there's nothing fishy going on. This can be with regard to mistakes or errors made in the company, or it can be regard to purposeful theft inside the company. That tied into point three, safeguarding assets. A company must have measures in place to prevent loss of valuable assets, especially those which are most liquid. So, it can be tricky to steal something big and bulky, like a inexpensive piece of machinery. But imagine if you're a cashier and you have access to cash. It's very easy to steal cash because it's hard to prove whose cash it was in the first place. And second, it's quite easy to pocket it and leave, unlike a big bulky piece of machinery. So having good internal controls help you safeguard your assets. And finally, accurate, reliable information. A company must provide accurate and reliable financial information to help the user's decision making. So the more solid your process is, the more you can rely on your information, and that saves costs, especially when it comes to the accounting side of things. Moving on to Sarbanes-Oxley Act. This is a very important piece of legislation passed in 2002 after the Enron and WorldCom accounting scandal. So let's look at some key provisions included in this act. Before we do that, I'd like to talk a little bit about what happened back in 2001 and 2002. These two firms, they were actually giants, were found to have misled investors because their financial statements weren't reflecting the actual state of the organizations. So there were many people at fault, including the senior management of these companies. There were also the auditors at fault that didn't do their jobs correctly. And there were also lower level managers and employees at fault who decided to look after their own personal interest before everybody else's. So there were a lot of people to blame with these things. So as you're going to see, there are specific measures taken to prevent this kind of thing from happening in the future. One is the internal control report. Public companies must issue an internal control report, and the outside auditor must evaluate the firm's internal controls. So the idea is that you document all the measures that you take with regard to internal controls so that the auditor can determine if you're doing things as correctly as you should be. And also external parties like investors and creditors can also make a decision on if your processes are safe enough that they can rely on. Point two, Public Company Accounting Oversight Board. Independent board oversees the work of auditors of public companies. So this is an example of a government body being created to oversee the auditors themselves. Are they doing a good job of being independent and being thorough in their audits of publicly traded companies? Separation of consultant and auditor functions. An auditing firm may not also perform certain consulting functions for the same client. The auditor is compensated for auditing service only, which helps maintain audit independence. So this is a major one. Arthur Andersen, which was the auditor for Enron, was getting paid $1 million a week for providing consulting services for the corporation. And this was a much higher fee than what they received for auditing. So the implication was if we weren't getting a clean audit from Arthur Andersen, we would find a different consultant. So you would lose a whole lot of revenue if you didn't comply with what Enron wanted. And that was a severe example of audit independence being compromised. Last point, stiff penalties for violators. 25 years for imprisonment for securities fraud and 20 years for an executive making false sworn statement. So the penalties for engaging in evidently fraudulent behavior, they are a lot more severe than they used to be. So that's supposed to serve as a deterrent. Some components of internal control. A business can achieve its internal control objectives by applying 5 components. Control environment. The owner and top manager should set the tone for the organization and practice good behavior which influences employees positively. So the culture of the organization really starts at the top. So if lower level managers and employees see that their bosses, who are getting paid a whole lot more money than they are not complying with ethical behavior, then they're very unlikely to also do what's right. So the senior executives should set the standard for the organization and follow those standards as closely as possible. Risk assessment, identifying risk which a company faces, can better enable management to manage those risks. So there should be a process in place where they regularly identify risks and also sit down and discuss how to manage those risks. And then once you have your strategy for risk management, you try to follow it as closely as you can. How do you follow that? You have control procedures. These are the rules and processes. So assigning responsibility, separating duties, using security devices. These rules and processes are designed to ensure a business's goals are achieved. So you want to set control procedures carefully to make sure that they do indeed serve your purpose, but they're also not too stringent to really hurt productivity. But you also want to follow those procedures carefully and monitor them to make sure they're achieving your goals. So that brings us to the next point, monitoring of controls. Internal or external auditors can be hired to monitor a company's controls. In a large firm, internal auditors monitor company controls to safeguard assets, while owners or managers perform this role in smaller firms. As covered earlier, external auditors monitor controls to provide assurance that accounting records are accurate. So no matter what, whether you're big or small, you want regular reflection on what your controls are, if they can be designed better, and if they're actually working. So it's more than just looking at the end result. You want to be actively watching employees to see that they're following internal controls. You also want to be asking them for feedback. And last but not least, information system. Accurate and up-to-date information is critical for keeping track of assets as well as measuring profits and losses. This is a relatively new branch of internal control as we have better and better technology moving forward. So we can take advantage of technology to implement stronger internal controls. So for example, think of an alarm system that ties into the barcodes on products. Think of security cameras placed above the cashier counter. So all of these things help us maintain better internal controls compared to what we had at our disposal just a few decades ago. Internal control procedures. No matter the size of the business, an effective system of internal controls has the following characteristics. So we have competent, reliable, and ethical personnel. Companies must hire qualified, well-educated, and skilled employees and pay them fairly. Training and supervision are also key elements of building a competent staff. Assignment of responsibilities. Employees should be assigned clear responsibilities so that all duties are carried out. Also, defining who does what is an important part of maintaining strong internal controls. So one way to have effective assignment of responsibilities within your organization is to separate duties. This involves dividing up responsibilities for transactions between two or more people or departments. This reduces the chances of fraud and promotes the accuracy of accounting records. Separation of duty can be divided into three parts. 1. Separate operations from accounting. Accounting should be completely separate from operating departments, such as production and sales. Without this structure, sales numbers could be inflated to achieve bonuses, and top managers would be misinformed about how much the company has sold. So, under this example, imagine somebody who earns commission for every piece of furniture that they sell. If people are responsible for inputting their own sales data, this person might be tempted to inflate their sales numbers. It might not even be a huge deal. This person might be working on the last day of the month, and a customer might have promised them to come by and buy 5 pieces of furniture. So the salesperson might feel that, oh, I don't want to wait a whole month to get paid for this. I'll plug in the 5 sales now so I get my bonus. Because who really wants to wait a whole month for a bonus when the sale is imminent? Well, for whatever reason, if the sale doesn't happen, the salesperson has just kind of created a little bit of a pickle for himself and the company. Number two, separate the custody of assets from accounting. Accountant must not handle cash, and cashiers must not have access to accounting records. Similarly, a warehouse worker who handles inventory should not have access to accounting records. In neither of these cases, inventory or cash can be removed from the premises, and accounting entry can be made to cover up the theft. So again, if somebody wanted to steal either cash or an asset from the company, it would be very easy if you had access to the company computer where you could make a journal entry to cover that up. So you could take a bunch of cash away and write it off as some kind of expense, either petty cash or bad debt, or you could actually take an item and make a journal entry, record it as missing or sold or what have you in the accounting system. So by separating out these duties, people who handle the accounting system and people who handle assets, you're creating an extra safeguard to prevent theft. Finally, three, separation of the authorization of transactions from the custody of related assets. The person who authorizes the transaction should not handle the related asset. For example, a manager who authorizes the payment of a supplier's invoice should not have the authority to sign the check. So once again, if someone is responsible for checking off what has been delivered and they're also responsible for signing the check, that's probably not a great idea. You should probably have the person who counts incoming inventory report to the person who signed the check. So everybody agrees that everything's all good, then the check is signed and the supplier gets paid. If the same person is responsible for counting and signing the check, it can be easy to defraud the company or even the supplier, which is not good business. To add to that, you should be especially careful around payroll. Payroll is kind of a dangerous area because that's naturally money going from the company to the person. So the payroll administrator's work should be checked carefully by a senior manager just to make sure there are no errors and also there's no overpayment being made to the payroll administrator or another employee. Proper authorization. Organizations generally have written rules to outline approved procedures. Any deviation from policy should require proper authorization. For example, a supplier might ask the bookstore's representative for employee ID before handing over a large order on account. Let's say I'm a new employee for the bookstore and I drive over to the supplier's workplace and say, I'm here to pick up a large order of textbooks. Well, the supplier might be a little bit suspicious if she hasn't seen me before. She might ask me for my ID, or she might even call up the bookstore, somebody she knows over there, and verify, hey, does this fella work for you? So any deviation from policy, make sure it's properly documented and authorized. Internal and external audit. An audit is an examination of an organization's financial statements and the accounting systems, controls, and records that produce them. Internal audits ensure that the company policies are being followed and operations are running efficiently. External audits are more focused on fairly presented financials and external stakeholders such as creditors, investors, tax collectors are not being misled. Use of Documents and records. Documents such as sale invoices and purchase orders, and records such as journals and ledgers help keep track of transactions and protect assets. Pre-numbered documents can be used to ensure there isn't an unexplainable gap in the sequence. So some of you might have a checkbook. You'll notice that at the top of each check, there is a number. So if you go in order, you can figure out if a check goes missing or there's some fraudulent activity going on. Use of electronic devices and computer controls. Technology can be used to boost internal controls. Electronic tags on merchandise, burglar alarms, security cameras, and point-of-sale terminals. Cash registers which record transactions can be used to protect assets. So this is becoming more and more common. Some of you might go to fancy clothing stores where they have a special tag on clothing, and there's a special tool that the cashier has behind the counter which they can use to remove the tag. So it's a good way to prevent people from walking away with inventory. Okay, so we'll stop this fairly long video here, and this is kind of a turning point in the chapter. We'll come back and look at the bank account and the bank rec. See you in the next video.